Good morning. This is Bruce at Fleet Capital Management. It is Saturday morning, the 23rd of December, 2023. We're going to take a quick look at the market from last week and also look forward to what we might expect next week. I'm going to show you a couple of fear and greed gauges and how well they correlate to actual market performance. So let's just jump in. We always need to state that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. I am always available, Bruce at fleetcapitalmanagement.com. Our website, fleetcapitalmanagement.com, two buttons over here. This one up top, you can click on that and that will schedule a Zoom meeting with me. So we can discuss things more personally, and then the bottom button will take you to the most recent market updates. William O'Neill, who many of you know, he passed away recently, and he was the founder of Investors Business Daily. And prior to founding Investors Business Daily, he was an extremely successful stock market investor and created a series of rules based on 100 years of historical evidence. I saw this quote from him just the other day that I thought was great. It said, successful trading is about finding the rules that work and then sticking to those rules. And that's William O'Neill. The next few weeks of videos, I'm going to start to introduce you to some of the rules that I use. And again, these have been time tested over a number of years, primarily by Bill O'Neill. And I'll show you those rules, and hopefully you'll find that interesting. This is something I look at from time to time, and I've shared with you from time to time. There are numerous behavioral finance studies from around the world that basically show when greed gets too high, when investors think this is easy, that can usually mark a top, whether it's a short-term or a long-term top. It's usually a short-term top in the markets. And conversely, when investors in general are extremely fearful and they think the market will continue to fall, then that's usually the very bottom of the market. I did a little overlay that I think might be, and right now we're in extreme greed, but we are lower than we were a week ago. Okay, so I did this for you. Let me show you. I hope this makes sense. But this is that extreme greed and fear chart as it changes, because it can change over time. It changes day to day. It can change week to week, especially. And the most recent market low, just trust this date, I'll show you this in a minute, was October 26th. And during that time, here's October, there was extreme greed, extreme fear. So what we find is when there is extreme fear, generally the market goes up. And if you look down here, right there is October 26th. Again, I know it's small, it's a little hard to see, and these scales are a little bit different, so they're a little bit off, but right there is October 26th. And October 26th, we had extreme fear. Look what happened to the market, okay? Let's go back a little bit in time. Let's go back to a recent high, which was July 19th. And there it is right there. July 19th was a high. Well, what did investors feel about the market? They felt, hey, this is getting really easy. I mean, look at this run up. This is getting really easy. Anybody can make money. That's called extreme greed. And when that happens, which it did back in here, the market fell. Okay, one more. Let's go back to March 13th. March 13th, there was extreme fear. It fell into that category right there. And look what happened on March 13th. A nice bull run began. So that's why I show you this. Is this the end all? Is this whenever it's in extreme fear, we should buy, and whenever it's in extreme greed, we should sell? No, but it is an early warning sign that things may be getting a little bit toppy. Okay, and if you were to draw a line from that peak, this is going to be very approximate to these peaks, to that peak, and we're not really there yet. That seems to be as high as extreme greed goes before it starts to fall. And if you were to draw a line here this way, you can see that that seems to be a low, and that's where we were. So anyway, I hope you find that interesting. I'm also going to show you in this video how using Fibonacci retracement tools can help determine trend continuation or end. This will make sense in just a moment. Okay, let's go over to our matrix updated on Friday, yesterday, and you can see group one, the most aggressive. They can handle more volatility. It's green and green. Group two, a little bit less aggressive, a little bit more conservative, kind of middle of the road. We're in green, green, and then all of our bear market indicators over here, of which this is the most important. That's why it's highlighted. These are all in the green, so we're just fine. And like Bill O'Neill said earlier in that earlier slide, have a rule and follow it. I have a lot of rules just off of this chart. For instance, the VIX. The VIX is a fear index. And when we are under 20 on the VIX, generally speaking, that means we're still in a bull trend and we can expect higher prices. When the VIX gets over 20, really over about 18, but let's call it over 20, that is a lot of fear is in the market. And this is very short term, by the way, and we can expect a downturn. So here's the rule. Plus 20, we tighten all of our stops and no new buys. So we have a lot of rules. That's just on the VIX. Here in group one, and this why it's highlighted is this is the most important. If the 8 daily moving average is not above the 21 day, we don't buy new securities. It's as simple as that. There's another rule that we have found works extremely well. For our weekly, the group 2 clients, if the 2-week, that's what the W means, if the 2-week moving average is below the 10-week moving average, this would turn red, and they will not buy stocks. They will not, that group will not be invested in stocks. So there are lots of rules around all of these things, and that's basically what Bill O'Neill was saying, is find rules that work and then stick with them. Okay, if we go over to the S&P 500, a couple things I want to show you here is this white line up here that I put on the chart. I'm going to scrunch this up so maybe you can see it. There we go. Back in January of 2022, which is when the bear market, there's the bear market, started. This was the previous high, okay, right before the bear market started. Right now, we're getting really close to that high. Now, in order for this market to surge significantly higher, then this market will, by necessity, have to break through that high. An old high tends to act as resistance. You can remember on an earlier video, we talked a lot about support and resistance. Resistance is the ceiling in your room, and you can get through that ceiling, but it might take you a few times to punch through it to get above it. A support level is the floor. It's what you're standing on, is on the floor. So we're really close to that level of resistance. Many times, not always, but many times it takes a few tries to get through, but this can be a difficult area. We're also at a round number right there, 4,800. Round numbers tend to be psychological numbers. Just that's the way our minds work, and they tend to act as resistance as well. So we need to break through 4,800, and we need to break through that all-time high to go higher. I suspect it's going to take a few tries. I don't think that's going to be easy to get through. Okay, that's number one. Number two, the blue line is the 20, and then we've got the 50, and then the 200. Perfect. And the 8-day, which I use for trading, is also above. So everything looks good there. I won't go through all of our rules on these, but I'll do that on another video. But there are rules around every one of these lines, and especially crosses of the lines. And I'll explain that to you later. Also, remember, we changed to a new coloring pattern. This is the Lux coloring pattern. Green is bullish. Purple is either sideways or transition. Red is down. So here we were in a downtrend. We transitioned, and then we went into a bull trend. Okay. Here we were in a bull trend. Purple, we transitioned into a very short-term downtrend and then went right back in. So everything looks good there. Now, let me show you Fibonacci retracement for a second. There's a high. You see that little wick, we call that? sticking up because these are candle charts. So the top is a wick, the bottom is a tail. That is a recent high. Let's say the market over the next week or two starts to fall. What I would do is I would take my Fibonacci retracement tool and I would go to the most recent low, which is right here. That's called a swing low. And then I would connect that to the most recent high. Okay, there's our Fibonacci retracement. So let's just assume the market gets weak and starts to fall, which actually I might expect in the beginning of the year. How do we know that the fall is normal? As opposed to how do we know that a trend has changed? Well, one way we know is Fibonacci retracement. We went from swing low to swing high, and then you see this white line right there? That's 50%. That's 50% of this move. And the other line, it says 0.618. That's 61.8% retracement for that move. So these are two very, very important numbers. If the market came back down to the 50% or to the 61.8% or somewhere in between, which is very common, and turned back up, then that signifies to us that pullback is over and we're going to continue the trend. If the pullback breaks 61.8 and continues to fall, that's a really strong indication that that trend is over. And there's other ways we do this that are faster, but I just wanted to show you this one. Let me show you a couple other interesting things. If we go from this swing high to this swing low, then the market came back up, and where did it go? It went to 61.8 and continued its fall, which means all of this in our minds, technically speaking, is one fall of the market. Let me show you something else that's kind of cool, a longer one. If I go from, I think it was this swing low to this swing high, do I have enough room on my chart? No, I need to change that. Bear with me one sec. Get rid of that. What I wanted was, let's go down here. Here was the swing low. I didn't have enough room on my chart. Okay. And there's the swing high. Okay. So if we go there, there's a really long one. And then we had this pullback. You see that? Where did the pullback go? Where did it stop? That's 618 right there. That line, that white line is 618. That's where it stopped. And then it bounced and it went back up. So using these Fibonacci retracement tools, we can use it on very short-term trends and it works. We can use it on long-term and it works. I mean, does it work 100% of the time? No, but it works like 90% of the time. I mean, it's pretty extraordinary how often it works. Why? Why does it work so often? Why is technical analysis such a phenomenal tool? In a way, it's a self-fulfilling prophecy because algorithms, which is computer trading, which really since 2000 has exploded. If we have a really strong pull-up, many institutions that use algorithms will put in an algorithm that says if the market starts to turn down and it gets to 0.5 or 618, that's where I want you, computer, to start buying more. I want you to start buying more because that's such a probable low. And again, it doesn't happen every time, but it happens a lot of the times. And that's just one example of an algorithm. So since everybody's looking at it, since I'm looking at it and everybody else, if this market started to come down, we're not going to be buying new stocks. But if I see it hit 618 and start to turn back up, I'm going to probably buy stocks. That was simplistic. I have lots of other indicators that have to correlate with that, but that's what I wanted to show you. So hopefully that makes some sense. That's using Fibonacci retracement. One other thing I want to go over, our stocks are doing extremely well. We had a really bad day with one stock. That is NetEase. NetEase just, which has been a kind of a pain in the neck stock anyway. It fell out of bed. And the reason it did, let me see if I have the article. Here's the article from yesterday. Chinese game developers tumble on new government crackdown. The Chinese government is trying to crack down on the amount of time their citizens are online gaming. Good luck with that for any of us who have had a teenager who spends on their time gaming. So this happened. It was a regulation that just came right out of left field. No one had anticipated it. All of the gaming stocks, of which NetEase is one, fell out of bed. Now, You may think, and it would be reasonable to think, well, why didn't you have an automatic stop? And then we wouldn't have seen that type of decrease. Well, you've got to understand how automatic stops work. An automatic stop is it converts to a market order and then it trades. This opened down 27%. It opened. So it would have gone right through our stop and it would have stopped us out somewhere right down here at a negative 27%. So that's, I didn't have an automatic stop. Now, the stock continued to trade back up through the day and closed much, much higher. And actually it closed down 16%. So right around half or 60%. So that's why I'm not using automatic stops, because we would have been out with a 27% loss. Right now, we've got about a 16% loss for that day. What I'm going to do is wait and see what happens on Monday. Granted, we're in a holiday week, so there's going to be low volume, but I just want to see if this starts to creep back up. The reason is it's a good company and algorithms may be in place that say if this, and that's probably what happened down here, if the stock falls because of some strange news event, start buying. And a lot of buyers came in. I want to see if that's going to continue. Then I'll make a decision where to pull the trigger on this stock. The other thing that I found fascinating, going back to technical analysis, I always say look left to learn. I went down here and I looked left, and the previous, this is called a swing low, was right there, and I put this purple line on that last swing low. Look how close this got to its swing low. Again, a swing low can certainly act as support. So there was a low here, there was a low right around here. So that's just kind of normal how that happens. But in any event, no one could have predicted this. We're going to wait and we're going to see, and then we're going to get out of it. Being down 16% or even 20%, if we're down 20%, that doesn't kill us, because if you take 5% of your portfolio, which is, that's what I had originally put in NetEase, 5% of 20% is 0.4%. So to your overall portfolio, it dragged your portfolio down 0.4%. And I hope that makes sense. If not, I'm happy to go through that with you one-on-one, the way that math works. So in any event, that's the only stock that I have not been happy with. Going back to the S&P for a second and putting on our linear regression, we were really close to the top of the linear regression, really close to 4,800, really close to that resistance level. Not surprising at all that the market came down a little bit. What it will do in this next week, no idea. A lot of people, there will be very low volume, and I suspect not a lot's going to happen next week. We really kick back into gear after the new year. Next week, we'll talk about what we expect in January and in the new year. But we are, this was a really strong run. And after strong runs, we tend to see lows. We had a strong downdraft, and then it went up about 6.18%. Then we had a downdraft, and then it went up. That is normal. A straight up line isn't really normal. So the reason I tell you all this and to end on this video is if we do have a little bit of a break, don't think that the bull market is over. That absolutely is meaningless. And that's what CNBC will say and everything else. We have a lot of tests to see if that run is over. Clearly, I don't think it's over, and I think 2024 is going to be excellent, and I'll show you why in next week's video. Okay, so in an effort not to go too long, let me just say I hope you have a wonderful Christmas. I hope you're warm. I hope you're well fed. I hope you have family and friends around. The world's a little bit crazy right now, but it seems like we say that every year. So we need to focus inward and on those closest to us. Have a great weekend, great Christmas. Monday, obviously, we're closed for Christmas. So I will be back on your accounts on Tuesday morning. And then the following Saturday, we'll do kind of an end of the year and look forward to 2024. Okay, hope that helps. Talk to you soon. Bye-bye.